Hey everybody, conversation that I've wanted to have with all of you for, well, a while now and put out this video is fixed versus variable rates. There is a lot of discussion right now in the media about variable rates going up, fixed rates going up, rates are going up, everybody should be panicking. Um, there's something that's interesting out of all this. It's quite frankly, nobody has a crystal ball, so everybody's taking best educated guesses. There is a chance that variable rates will be going up, but quite frankly, the interesting part of this is that those who benefits the most from you calling into your bank and locking in to a fixed rate, it's the bank. And a lot of these articles are coming out are from the economists representing those banks, so a little bit interesting in that perspective. However, it's difficult for us to really sit here and tell clients, listen, historically speaking, variable rates are cheaper than a fixed rate, allows a lot of flexibility, et cetera, et cetera, et cetera. It's hard to say, well, you may also actually come out ahead regardless, and take my word for it. So rather than just taking my word for it, we've built together, well, we've built a little presentation, if you will. And I'm just going to share my screen real quick so I can show you kind of what I'm looking at here. Um, what we've done here is we're going to illustrate a $100,000 mortgage amortized over 30 years at an approximate 5-year fixed rate that we could offer today. It's actually higher on average, but just for illustrative purposes, and approximately what we would get on a variable rate as of today as well. So the reason we're using $100,000 is because it makes the math really simple. So when I'm done my summary that we'll see in a few moments, you'll see the net difference between the two. And with $100,000, it's simple for you to just say, well, if I have $300,000 mortgage, it's that times three, right? So that's a breakdown of what we'd be looking at in this respect, comparing fixed to variable, whether you're looking at taking out a new mortgage or purchasing a new home or what have you. This is just a breakdown for that. So if we look at the prime rate since 2007, we can actually see that historically speaking, when there is a change in prime, the Bank of Canada, when they do meets, they tend to increase by a quarter point at a time. So 0.25% each time they look to increase. So what we're going to do is we're going to build out this table here to say, okay, every 6 months, that's what I'm going to decide for the next 5 years, every 6 months, we are going to have an increase of a quarter point. So that could be aggressive. It could be not enough. Nobody really knows, but I think it's a pretty fair assumption to make that, okay, well, let's assume that every 6 months they could potentially increase by a quarter point. So we don't exactly know how that would play out in real life, but this is, again, for illustrative purposes, and I'd like to show you how that may actually work out over this 5-year term comparatively. So what would happen here is that you can see that it would take about 3 years at this point here, about 3 years to basically level out to where you would have been if you took a fixed rate. So you started at 1.5%, you had multiple increases. By the time you get about the 3-year mark, that's how long it would take to get to the 3%, same as the 3% as if you were to take a fixed rate today. So there will be additional increases beyond that because you have a 5-year term. So what does that actually mean for you? Well, if you take a look at the summary tab, we've actually broken it down. So this is if you were to take a fixed rate off of the bat, total payments made, total principal paid, total interest paid, compared to the variable with all those increases. So what you'll actually see is the difference isn't necessarily substantial for the principal balance at the end, but there are savings in terms of the interest paid and the actual payments paid. So of course, starting at 1.5% compared to 3%, your payment will be lower. Yes, it could gradually increase, but frankly, if you're okay with paying a fixed rate payments right off the hop, what we can actually do is we should be able to say, hey, let's get you the variable rate at 1.5 at about half of that rate and set your payment higher already. So we're actually paying off even more principal. But that's just, it's a discussion to have on the side as well. All this to say that In this particular case, every 6 month quarter point increase on prime, you're looking at $1,700 in net savings in favor of the variable rates. I guess, and frankly, whether or not that was, that's enough for you to consider, well, that, I definitely want to take the variable because $1,700 is a good amount of money. For me, I guess what doesn't get really discussed enough is the options that come with the variable rate. So a lot of individuals don't happen to know that if you break a variable rate mortgage at any point in time, whether it's a couple of days in, a couple of months in, a couple of years in, it's a 3-month interest penalty. A fixed rate, it's a much, it has the ability to be a significantly higher penalty depending on where rates are at that time. Generally speaking, when you see those news articles with, oh no, I got hit with $25,000, $30,000 penalty for my mortgage, I had no idea. It's usually a fixed for the most part. You won't typically see a variable penalty that high unless you've got a very large balance, of course. So all this to say is that for me, even if the net savings was a break even, even perhaps slightly in favor of the fixed rate, variable for me, it's almost like an insurance policy against your mortgage, if you will. And the reason I say this is because you do have the potential to actually save on interest, but more importantly, a lot can happen in 5 years. Taking a 5-year fixed, you are saying to the bank, I'm promising you, I'm not going anywhere for 5 years. I don't want to make any changes. I don't want to look at buying a rental property. I don't want to look at taking money out for renovations. I'm not touching my mortgage for 5 years. And if you do with a fixed, you're hit with a pretty hefty penalty usually. Whereas a variable, the penalty could be significantly less, allowing you that flexibility to consider breaking the mortgage down the road without having to, worry about that large penalty. So with all that being considered, yes, you have the ability to save with a variable. And historically speaking, as mentioned, variable ends up being cheaper more often than not than a fixed rates, but you also have that flexibility. So all this to say that if you are considering your options, reach out. I'm happy to help out, whether you're dealing with your bank or whomever, and you're going between fixed and variable. If you're sitting here reading the news and you don't know if you should consider locking in, pick up the phone, give me a call. Happy to chat, happy to go over the different options for you and play out some different scenarios. Either way, I'm here to help. And thanks for everybody for the feedback of late and the great last year. It was fantastic. I always appreciate your support. Have a great day, and we will hope to talk soon.